Good afternoon, everybody, and welcome to the ENS Africa webinar, which forms part of our tax webinar series. And today we're going to unpack the 2021 budget speech. We are really pleased that you've taken the time out to listen to our analysis of this year's budget. My name is Charles de Wet, and I've recently joined ENS Africa, having spent most of my career specializing in VAT in an advisory capacity. As there were no significant VAT announcements in the budget this afternoon, I will be facilitating this session. I have been tracking the number of words that the Minister of Finance uses in his budget speech over a number of years. This year, interestingly enough, Minister Mwene only used 3,876 words, which is 2,000 words fewer than he used last year, and cannot even be compared to Minister Gaba's and Gordon's speeches in earlier years where the total number of words were in excess of 9,000. The tone of this afternoon's budget is good, and it certainly favors growth instead of tax increases. However, enough has not been done, and individuals have been prioritized ahead of business. While the reduction in the corporate rate is good news, the above inflation fiscal drag adjustment is higher than I think was really necessary. The 8% increase in excise for tobacco and alcohol, which was probably the biggest announcement in the budget, is very high, especially taken in context of the trading restrictions during the COVID-19 pandemic. And I'm sure that the players in illicit trade really welcome this increase. On the VAT front, there were only 3 announcements on super maize meal, residential property developers, and gold. We can take credit for bringing both the super maize meal and residential property development changes to the attention of National Treasury. Ahead of the budget, we also predicted a reduction in the corporate tax rate. While we hoped it would be more than 1%, at least we got that right. We are certainly very proud to be part of the largest tax team in Africa, which is housed in a law firm. And we continue to grow as 4 new tax executives have joined us during the last year. But let me introduce let me welcome our panel and introduce them to you. Our guest panelist this evening is Araj Abedian, who is the founder of Pan African Investment and Research Services. He is extensively involved in policy development in South Africa and has served on the President's Economic Advisory Panel, and is a well-respected and does a lot of research and has authored a number of books. From the ENS Africa team, we are joined by Mike Benatello, who specializes in corporate international tax and mining tax and has more than 20 years of consulting experience, and I know has spent a number of years also analyzing the budget on budget day. In addition to that, we are joined by Jenny Klein, who specializes in employees tax, individual tax, and international tax matters for individuals, and is closely involved with both inbound and outbound assignments of employees. The budget always includes a number of announcements on taxes for individuals, and she will share what she's managed to glean from the detailed documents in the time since the budget was completed this afternoon. Kazi Magaleli is also a corporate tax specialist who specializes in the financial services sector, mergers and acquisitions, and international tax. Her experience in commerce gives unique insights to how the budget will impact your business. And she's also spent the afternoon analyzing the detailed documents and getting to the golden thread that is in any budget document. On to some housekeeping rules quickly. We are a big audience today, so answering of questions will be complicated and for that reason limited. You are very welcome to post your questions on the Q&A box, and we will do our best to get it in, to respond to it either there or during the session if we have time. Also, for your information, the webinar is being recorded and will be posted on the ENS YouTube Africa channel. Sorry, the ENS Africa YouTube channel. We will start this afternoon by asking everybody to give a very brief impression of the budget speech, and then we will spend some more time doing a deeper dive into the analysis and some of the detail that is in the detailed documents, the budget review, and not the minute's speech. So welcome to everybody, and especially welcome to the panel. Iraj, we are very pleased to have you with us this afternoon. And could I ask you to reflect on your thoughts on this afternoon's speech?
Thank you very much, Charles, and greetings to everyone and fellow panelists. I think all considered, the budget, from what we heard from the minister, is better than expected, better than many had predicted. The rumors about tax increases and a whole lot of other revenue-raising attempts turned out to be incorrect. So in that sense, the minister was quite cautious and in fact very meticulous in building expectations and reviving a positive sense of government and national treasury being in charge to make sure that they make the right decisions, tough but right decisions in the correct direction. So in that context, a few signals about cutting corporate taxes as opposed to increasing it, giving the individuals more relief than anybody expected, even beyond the inflationary adjustments into bracket creep. All of these tend to build confidence. So from that point of view, from a macroeconomic point of view, these are positive aspects of the budget. We can come to some of the details. May I just say on the balancing side, where the minister expressed concern, but I don't think he did enough, is the reality that government sector or public sector as a percentage of GDP is now north of 42%. That's a very, very uncomfortable and unfavorable threshold for the economy, because the relative productivity of the public sector is always substantially lower than the private sector. And the more the share of the public sector as a GDP rises, the more overall productivity declines. Now compare this 42% with 10 years ago when it was 26, 27, between 26 and 28%, vacillating in that. And that shows how much we've had the public sector creep into the economy. And that, of course, brings with it inevitable issues of rising public debt, and the economy not performing as much because its overall productivity is falling. So these are some of the details that the minister sort of mentioned, but they really didn't deal with them in saying in what direction it's going. The fact that the minister has committed to public debt to GDP coming down from close to 90% to much lower is not really under his control, because it all depends on the denominator. Remember, debt to GDP is a simple arithmetic ratio, the numerator denominator. If the denominator doesn't grow and grows substantially and sustainably over a decade or so, there is no way that public debt to GDP can decline, because on the numerator side, most of the components of public expenditure are contractually bound. There is very little discretion in it. For example, public sector wages, public debt servicing, welfare payments, and so on and so forth. So overall, as the public sector share of the GDP has risen, the discretionary part of public expenditure has diminished, and the non-discretionary or contractual side has increased. Therefore, government increasingly is going to have less and less capacity to contain expenditure. Therefore, the focus has to be on the denominator, which is how to grow the economy, and we can come back to that. Thank you, Charles.
Thank you very much, Iraj. Let's start talking about the tax side of things. Mike, are you going to disagree with Iraj?
Thanks, Charles. No, I'm not going to disagree with Iraj at all. I think maybe the one aspect that I think is was quite surprising, and I guess there's a lot of joy around that in the tax community, is that the minister abandoned the methods or the proposed changes that were going to come about to raise an additional 40 billion rand of tax. I think that's what we we're really all worried about what were those measures going to be and what were they going to announce in the budget. I guess, as you correctly point out, we did predict a reduction in the corporate tax rates. Our prediction was maybe a little bit higher than 1%, but we can unpack that later, as to the reasons why it might only be 1% at this point in time. But at least a platform has been established to work from this position going forward, because I do think tax is not the only thing to determine whether you set up an operation in a particular jurisdiction, but it goes a long way to making South Africa a little bit more competitive. And then on balance, there were certain mentions made of certain things like the multilateral instrument, the taxing of e-commerce, the direct taxes on that, certain mentions made, and then dealing with incentives and assessed losses and interest. All of those aspects we can probably unpack later in the discussion. So I think well balanced from a corporate tax perspective, and some amendments in Annexure C, which are not too complex, but are welcomed by us as well. So I guess on balance, I think it was quite fair. Very happy the 40 billion rands worth of measures have gone away, and nice to see that South Africa is starting to look at reducing the corporate rate. So those are really my takeaways, Charles. Thanks.
Thanks, Mike, very much. Jenny, from an individual perspective, and maybe from an international perspective in terms of taxes that individuals pay, what was your take on this afternoon?
Thanks, Charles. Well, I think from an individual personal income tax perspective, as has already been highlighted, the announcement is an above inflationary adjustment to the tax brackets and the tax rebates. And if you couple that with the fact that no increase in the personal marginal tax rates have been announced, that translates into significant savings in the tax liability for personal taxpayers. I think on the international side, last year we saw, for example, an increased tax liability for South African residents who work abroad and who then no longer qualify for a full tax exemption. So I think on that side, that amendment was effective last year and has made a significant increase in the tax liability of many South Africans who work abroad. But overall, from a personal tax perspective, these announcements are welcome. There was also an inflationary increase in the medical tax credits, which maybe has less impact, but is still positive. So overall, from an individual perspective, this is a welcome budget for individuals. Thanks, Charles.
Kazi, moving on to international tax, were there any significant announcements from a business perspective, or are we going to see are we going to see a significant amount of investment in the next little while?
Hopefully so, and the reduction in the corporate income tax rate, that would definitely help. Nothing earth shaking on the international tax side, but the one thing on financial services, which for me is actually a bit concerning, and this was a proposed change that is included in Annex C. And I'm worried about this change because it's got a potential impact, big impact on the collateral industry. So from a tax point of view, a collateral giver can actually give collateral to a collateral taker with listed shares or bonds, and that transaction would actually be tax neutral from an income tax point of view, as well as securities transfer tax. So now what they're actually looking at doing is to control somehow the reuse of the collateral taken by the collateral taker. Because a collateral taker could actually use the collateral in respect of activities, or could actually place that collateral in another collateral arrangement. So now saying that the policy has always been that the collateral that is reused can only be used in respect of another collateral arrangement. So that is actually in terms of how the collateral can be used. I mean, you're looking at a multi-billion industry, the collateral industry, that has got the potential impact of impacting that industry in time. For me, it's definitely something to watch. It looks as though there might have actually seen some abuse in the industry. It sounds like it, we don't know, but we definitely need to look out for that from a financial service. Yeah. Thanks, Charles.
So it sounds like there was lots of doom and gloom predicted and anticipated, and we've come out ahead of that, which is, I mean, a good way to run the budget in terms of, you know, setting the expectation bar as low as you possibly can. Raj, can we unpack, I mean, a little bit more of the economic aspects of it? You know, maybe on the expenditure side, where you saw significant movements happening, and possibly even things that weren't there at all that you would like to have seen?
Starting off with what I believe the minister left out, and the markets were very concerned about, especially the capital market, is what's going to happen to the restructuring of Escom and the debt, and how that 450 or 460 billion rand Escom debt is going to be resolved, because that is a big issue from two perspectives. One is Escom sustainability, which is about energy and about economic activity, mining, manufacturing, everything else, but also from a capital market point of view, debt holders and potential lenders. The minister completely ignored that issue. If you recall, last year and the year before, he was quite vocal about it, that there is a drop dead deadline of March this year, or from April this year will be a new organization restructured. Its debt will be resolved in one way or another. The fact that he left it out, for me, is a negative thing. And likewise with other SOEs. In the past, the minister and the National Treasury broadly have taken a very commercial and a very strong line on not supporting bankrupt and incapable SOEs. This time around, there was absolutely nothing. So it looks as if the minister was quite careful to keep all the good news in the budget speech and to leave the details of the not so good or bad news out of the speech, which for me is not a good thing, because budget speech is as much about numbers as it's about providing a direction for the key elements of fiscal policy, which is broadly three areas: growth and tax, expenditure allocation, and debt planning. At the moment, our debt is too high. It's putting huge burden on our children and the next generation particularly, and it has consequences for people deciding to stay in the country or not. I'm talking about the skilled people. I'm talking about the young people who are in their 20s and 30s, and that there was very little in the budget about that, and that's important. The second area that I believe the minister did not deal with is the entire inefficiency or application of funds in state-owned enterprises. In the past, he was very strong on that they will not support, they will have capable people appointed, otherwise funding will not go to such entities. And yet we see he put 7 billion rand additional money over and above the 8 billion already given to the land bank without any conditions. I'm sure there will be discussions, tough discussions, but it would have been very important to symbolically and from a policy point of view to say, yes, we have to give 7 billion to land bank because agriculture is important, land distribution is important, success of black farming is important, but there are conditions attached to it. So I think for me, those are the missing points in on that direction of fiscal policy. If you like, there is a new dawn, as we have been promised. The new dawn has to have nuts and bolts explained and consistently emphasized, so that the use of public resources become in line with productivity and turnaround of the economy. The last area that I like to comment on is the broader issue of our municipal sector. Our municipalities are in a state of disarray. They have been and they remain, and that is where the bulk of service delivery, not just from a welfare point of view, but also for the support of the small businesses kicks in. Small businesses cannot thrive if basic urban amenities are not in place. If basic security of their operations is not guaranteed, and sewerage and water and etc. are not provided. So to the extent that municipalities are by and large inefficient and they are neglected, the Minister of Finance is in charge of a huge sum of intergovernmental finance that goes to these municipalities. I was disappointed that he did not make a big issue out of it. I understand that from a political point of view, it's tough because the next year's local government elections come in, but from a macroeconomic and from fiscal management point of view, we cannot overemphasize how important it is to get the local government sphere in South Africa on its feet. And I think that was missing for me in this budget.
Thank you very much, Raj. Jenny, I mean, there seems to be a lot of detail about announcements on the individual taxes. So kind of beyond the rate, it seemed to me as if chapter 4 and Annexure C that deals with the details had more commentary, more proposed changes. Can you dig into that in some detail, please?
Certainly, thanks, Charles. You're correct. There were a number of comments in the budget review which indicate that there are certain things under consideration by SARS and National Treasury which will impact on individuals. So aside from the adjustments to the tax brackets and the medical tax credits, there was a statement made that in light of the Davis Tax Committee recommendations regarding a wealth tax, SARS is proposing to consolidate wealth data for taxpayers using information provided by third parties, which is a reference to the automatic exchange of information system that's in place between SARS and revenue authorities in other countries. So I think we can expect some developments in that regard. SARS is apparently looking at the feasibility of a wealth tax. And they will have the information at their disposal on which to base such proposals should that come to light. The other point that I wanted to mention in terms of upcoming or forthcoming developments affects individuals who cease to be tax resident in South Africa. The proposal is being considered. It looks like the plan is to trigger an automatic withdrawal benefit from a retirement fund when an individual ceases to be tax resident, in the sense that there will be a tax liability calculated. And the proposals are not entirely clear, I must say that. I think one is reading between the lines what the budget review says, but it looks as though there will be a notional tax liability calculated at that point in time. And then if the person actually decides to keep their retirement interest in that fund until they retire or die, if that happens earlier, then the tax liability that's calculated when they cease to be resident, it looks like it will be deferred until there's actually a lump sum benefit or an annuity benefit coming out of that fund. So that, I think, is something to pay attention to, particularly for individuals who cease to be tax resident going forward in South Africa, because that can have an impact on their retirement savings and how they can, what they'll be able to do with them. There are a number of other amendments dealing with retirement funds and retirement fund benefits, and one of them is not entirely clear, but it looks at the statement is made they want to maximize the available retirement capital for the provision of an annuity on retirement. So I'm not entirely sure what that will look like when it comes to the actual legislation, but it's again something to bear in mind for members of funds who will retire from a fund in the future. When it comes to individual taxpayers, I think a fairly welcome proposal is that SARS is looking at considering how the travel allowance provisions and the home office deduction provisions operate in the context of the sort of large migration towards working from home. So I think that's something to be welcomed in the current environment. Again, what those proposals will look like is not specified, but I think it's something that will be welcomed. In the context of the anti-avoidance rules around loans to trusts, I think what they're looking at is expanding those rules to include situations where loans are transferred between different trusts, and to create an anti-avoidance rule around that. From an employer perspective, the last thing I want to mention is that there's a proposal to amend the Employment Tax Incentive Act. And this is intended to deal with schemes whereby training institutions are used to claim ETI incentives in respect of students. So this is, according to the budget review, perceived as abuse, and they're planning to make amendments to the ETI Act to deal with that, situation. So there are a number of amendments, but I think, Charles, those are the main ones that impact on individuals and employers. Thank you.
Thanks very much, Jenny. Mike, can we move on to the corporate side of things? I mean, if you look at again at the detail, I mean, it's interesting that the minister in his budget speech said there was be a 1% reduction. In fact, the budget documents only talk about a reduction. So I'm not really sure, whether there was a bun fight about that in the background, and there was a lot of, disagreement as to whether it could apply. And then also, if you look at it, in fact, it only applies from financial years in 2 or 3 years' time. 3 years, in fact. I mean, do you think there's any message in that? Can you talk to some of the corporate detail that was announced, please?
Sure, Charles. Look, I think the reduction of the tax rate by 1% is a step in the right direction. And yes, it is only effective 4 years of assessment commencing on or after 1 April 2022. So it's a little while off into the future. But I think the rate, it sends out the right message into the market, because reduction in corporate rates, is something that, or reduced corporate rate is something that corporates do consider when investing in a particular country. Now, I think the reason for the deferral of the implementation of the reduced rate, and he did make promises that the rate could go down even further. There were 3 aspects. So there's conditions attaching to that. And it was the reconsideration of incentives, tax incentives, the reconsideration of interest deductibility, and the reconsideration of how assessed losses are treated in corporate. So it's kind of like a matching principle, if you know what I mean. So one mustn't lose sight of that. So I suspect if they can recover the revenues that they suspect they're losing through assessed losses that have built up over the years, excessive interest deductions, and maybe incentives that are out in the market that really haven't created the incentives they hope, like job creation, etc., they seem to balance it. So to the extent that they can recover the taxes there, they think they can push the rate down. So I guess that's where they're going. So there's no hidden message. I guess that's the reality of it. And optically, a reduced corporate rate, it looks good on paper, but if guys are going to operate in South Africa with limitations on them, it might be problematic. Now, let's take each of these limitations or considerations, let's take them one by one. Let's look at incentives, for example. I guess most notably in this budget is the fact that the venture capital allowance or incentive, in terms of which if you buy shares in certain qualifying businesses, etc., so venture capital companies, you get a tax deduction for the acquisition of the shares. So that incentive won't be extended past the 30 June 2021 deadline. So, it was a nice incentive to have for people who could afford to get into these investments, especially to shield, for example, a capital gain in a year. But I guess what Treasury have shown and what government have shown in the budget today is that their drivers, for example, employment, etc., those weren't really met to the standard that they thought they would. So they don't see value for South Africa in that incentive, I guess. So that's the one aspect. And also when one talks of incentives, there's also a perception in the market that the mining industry, for example, have an incentive in the terms of which they get specific capital allowances which differ from other taxpayers, for example, manufacturing industry type taxpayers, etc. So that issue with the mining allowances we dealt with last year, and it was delayed or deferred in terms of coming into application last year. So that's something which still needs to be debated with National Treasury this year. And we do know that there would be forums to debate that, to see to what extent that will be applied in South Africa. Moving on to the second point that the minister made, was that there'd be a relook at the interest deductibility. Now, that is in line with global best practice, with BEPS, and every country around the world is doing it. So it's not that we're doing something unique, but I guess the point, and this was raised in last year's budget in any event, where South Africa seems to have landed on that, is that interest deductions between connected parties, and it will obviously be cross-border, would be limited to 30% of the EBITDA of a company. So that provision is set to come into effect in 2022. And the third provision relates to assessed losses. So there was also something tabled at last year's budget speech which limited the amount of allowance or tax loss that you could get a deduction for. So whether they're keeping that in place or not, or how that's going to change, we don't know. Now, both those, because of the COVID pandemic, have been deferred to 2022. Because those have been deferred, and because those are the mechanisms in which SARS or the Treasury is going to cover the losses on the reduced rate, that's the reason why I think the 27% will only come into effect on 1 April 2022. So I don't think there's anything misleading or any malicious issue there. It's just practically, let's get our head around the numbers. Let's see where we get to and how much we can actually reduce the South African corporate tax rate. So I think that's really the aspect there, Charles. Then other notable items that were raised in the budget documents is the taxation of the digital economy. I think many of us were expecting some form of announcement, or maybe even the announcement that South Africa would be going on some form of a unilateral type of taxing basis, which means that we would form our own type of tax based on best practice, like Kenya and other countries have done, Turkey, for example, and we would go ahead on that basis. Now, it seems South Africa has adopted more of the OECD type of methodology. So we're going to go on what they call a multilateral approach. So that work group that dealt with that particular aspect, because of COVID, that has also been deferred. So we probably only see movement on that towards the middle of this year. So yes, there will be a digital tax in some shape or form. So that's still coming, and that will also broaden the tax base. Just a point on the international tax base as well. The minister also mentioned, well, in the budget papers, aspects relating to the multilateral instrument. And that instrument is really going to change the way we look at international tax planning when selecting offshore structures, etc. Because if the only reason for selecting a particular country is to access the double tax agreement, then this multilateral instrument will override any benefits that one gets in terms of the treaty. So the point was made that the South African government still needs to ratify that. And then in that case, South Africa will deposit its instrument of ratification with the OECD, and it's got a staggered implementation dates, in terms of dividends, interest, etc. So some of the aspects will only come into effect within a year of depositing that particular aspect. And interestingly enough, South Africa's thought ahead, which is good, I think, for the South African fisc in any event, in the sense that to the extent that there are jurisdictions that we have double tax agreements with, to which the multilateral instrument would not apply, we are seemingly going to go through the process of renegotiating those treaties on favorable terms, I would suspect more or less in line with the positions that we want to adopt in the multilateral instrument. I made the point earlier on the incentives, and in the sense that, the minister said we want to relook at incentives and whether they achieve something. So it's not all doom and gloom. There's also notice in the budget papers on 2 gas finds that we found in the Mossel Bay area, and that the government's actually going to release Treasury is going to release a discussion paper on the taxation thereof, obviously to incentivize people to want to do the exploration and development of this find so that we can further enhance our petroleum industry. So I think there's good aspects that came out of that. Also, I think in terms of tax administration, which we must never lose sight of as well, the government they've also made an indication that they are considering, re-looking at the advanced tax ruling system to make it more efficient and effective. And they're also re-looking at the voluntary disclosure programs to see whether that's achieving the objectives. I was also very pleased to see that 3 billion rand's been allocated by the Treasury to SARS to to help them to modernize, to digitize, so that there's more efficient and effective, dealing with that. And I think that's with taxpayers. And I think that's the way, through efficiencies and effectiveness and repairing really all the aspects that the Nugent Committee or Nugent report raised, just to fix all of those aspects, to make the South African Revenue Service more efficient, more effective, as it's in all of our best interests. One last aspect before we deal with the Annexure C aspects was also an indication that they will be relooking the R&D, the research and development allowances, which many companies claimed, to see whether that has fulfilled the purpose for which it was set out. In terms of proposed amendments, so the Annexure C stuff, there's nothing too earth-shattering on the corporate side, other than, and we've hoped for this for a long time, a relook at the corporate relief provisions, which enable companies and taxpayers to roll over capital gains if they meet certain requirements. So there's certain of the provisions we don't really, from a practical perspective, have any resemblance to the economic reality. So those provisions will be amended accordingly. And there were certain aspects that were promulgated last year in terms of intra-group transactions and unbundling transactions. And there were certain carryovers from our discussions with National Treasury and SARS last year, which they've now, as promised, and I thank them for that personally, they've promised to relook in the current year. So those have made it into the Annexure C. So I think, Charles, that's really my take and my summary on the corporate aspects on a very high level.
Thanks, Mike. And I mean, the difficulty always is this now needs to get written into legislation, and then we start the debate about whether the drafters have chosen the words correctly or not. So the direction is right, but there's still a process to come. Kazi, you've sat in the advisory space, you've sat in business, in the financial services sector, dealing with changes, dealing with announcements like this. The detail that you would like to unpack in more detail?
Well, the two changes that I'd like to just mention. As Mike is actually saying, I'm actually looking forward to the world of tax in the future. It sounds very, very exciting with all those comments that have actually been made in the budget. But in Annex C, the one that they've brought through, well, they're actually intending to bring through, it relates to the anti-avoidance provisions pertaining to hybrid debt instruments. So what we have so hybrid debt instruments are instruments that have got characteristics that are akin to equity. So in substance, you've got an equity instrument as opposed to a debt instrument. So in that situation, what happens is that in relation to these anti-avoidance provisions, the interest deduction at the level of the issuer is denied as a deduction, and the issuer is deemed to have actually declared an in specie dividend. But now what happens is that there's economic double taxation that actually arises because the recipient of the interest, that interest is still treated as taxable interest. So in a way, you've got a situation where you've got double tax, where the holder of the instrument is taxed and then the issuer is denied a deduction. So they said they're actually going to look into that, and I think that's definitely a welcome amendment. So the other point that I want to mention in relation to long-term insurers, and the reason why I actually want to mention this is because it's been something that's very contentious. So your long-term insurance, they're governed by Section 29 Capital A, and then in respect of selling expenses or indirect expenses, the deduction there is determined with reference to a certain, we call it the expense relief ratio. And the expense relief ratio, what it does is basically a ratio of taking taxable income, and then you actually divide it by your net economic income of the, of the life insurer. And then you get this percentage, and this is a percentage that they apply to determine what could possibly be deductible. So what has been a controversy in the market is that when you're determining that net income, that net economic income, which is the denominator in that ratio, do you take into account unrealized gains? So this has actually been a very big thing, but some of the long-term insurers have always taken the interpretation that one should actually aggregate the unrealized gains as well as the unrealized losses. So they've mentioned now in the budget that they're definitely going to go that way. which I think creates certainty for the long-term insurers, because this is something that has actually been uncertain. In relation to other changes on the international tax side, immediate clarification of certain provisions, curbing on abuse in relation to some of the CFC rules, and just aligning some of the changes that have come through in relation to other provisions in the Income Tax Act. So I think those two, just checking my notes quickly, I think those two are actually just worth mentioning in relation to what we've seen. Thanks, Charles.
Thanks very much, Kazi. Mike, can I come back to you about some comments about the commissioner? The minister in his speech, always complimentary of the Revenue Service and the tremendous team that they have. You've interacted with SARS over a long period of time. We're seeing a lot of interpretations currently that are very revenue driven, and obviously they got some money out of it as well. Do you want to comment about kind of where they're at and where you see them going? Was there a policy direction written in this regard as well?
I don't know if there's a policy direction, but what it has obviously, given the COVID pandemic, I think they need to collect revenue. So they've been a lot more aggressive, I guess, and I guess rightfully so, because there's a job to be done. So I think from a tax-based perspective, it's always wise to be vigilant in terms of positions taken to get the necessary opinions. And if you believe in your opinion, then one should pursue it with all the power that you have in terms of the Income Tax Act. You have your rights as well, and so does SARS. So there's been an uptick in things like transfer pricing audits. There's issues with refunds, etc. So sometimes you just need to nudge them along and use the Tax Administration Act to rightfully get what's yours. But yeah, I think the focus, Charles, has been by SARS on protecting the basis is on the transfer pricing side, on international transactions, re-looking at treatment of specific allowances, etc. But yes, sometimes the things do get litigious, but I guess going forward, what the idea is to digitize the way they operate, maybe to identify high-risk areas and to focus on those high-risk areas in particular industries, which they've done quite nicely. If you look at the focus they've had on the retail industry, the focus they've had on financial services, and in a focus on sometimes on the mining industry and specific allowances there we've been involved in. So, the large portion of work and issue in the tax industry at the moment is dispute resolution, and I guess that's the climate we find ourselves in, Charles.
Iraj, I mean, the SARS brand and the way that they go to market and their success, including achieving targets, etc. So to an extent, it is interesting that their targets are lower for the first time since I can ever remember that. I mean, is that massaging the SARS ego, or is it just setting them up for success?
I think. Charles, is not about SARS's ego, it's about institutional integrity and institutional credibility. South Africa was internationally recognized between 1995 to 2007 for having achieved exceptional reform of its tax collection machinery and also putting in place almost an unprecedented tax morality or compliance. And that came out because SARS was transparent, was tough, was non-prejudice against sort of various strata of the society and businesses, small and big. And that gave it credibility. And that credibility is important for compliance and tax morality. As we all know, over the past 10 years, it's gone the wrong way in a sort of orchestrated way. Not only SARS did not meet its targets, but also lost a lot of systems and lost a lot of skills. Now, to rebuild that at a time when the society broadly has become a lot more, call it skeptical, is very difficult. So the current challenge for SARS is to choose taxes that it is sure to collect, It cannot speculate on type of taxes that at the end of the year it may not realize the projected numbers, not because it's incapable or it's corrupt, because just the nature of taxes is as such. So SARS at the moment on a journey to rebuild both its skill base and its systems. At the same time, a very important global disruption or revolution is at play, and that is the rise of e-trade, the rise of relocation of tax base or fiscal base. That's not unique to South Africa. Even OECD continuously complains that their tax being eroded because of the disruption caused by technology to their tax base. I'm sure our colleagues here and our participants know this, but to just be absolutely clear, when I order a book online or an item online, who gets the tax? Where does the impact go? Nobody knows. And of course, these corporates, international corporates, have essentially debased the fiscal base of all governments. Now, in that environment, SARS has to catch up. Many its counterparts in Europe and elsewhere, and in some emerging economies, they were with the trends. Some of them were ahead of trends, and yet SARS was being denuded of its skills and never mind building systems. So at the moment, these are the challenges that SARS faces, those three-part challenge. Make sure that its credibility is restored, its legitimacy is restored, because that affects tax compliance. Make sure that its systems and the skills are compatible with the modern economy. And thirdly, make sure that it stays ahead of the curve in a disruptive environment. Otherwise, its projections will not materialize.
Raj, if I could just sort of continue on that point, maybe a little bit, I mean, in terms of that development, and you said as a non-executive director on a number of companies. I mean, are boards of directors giving tax enough attention, or is it on the agenda in the boardroom? Are all stakeholders properly considered in that, or do you think that this is something that we will see changes on in the next little while as well, given the direction that SARS is moving in?
Look, by and large, I believe that the board of directors are not focused enough on these issues. A lot of them themselves have very little knowledge and skill to unpack numbers. Typically on a board of directors, all these issues are left to the audit committee. And the audit committee comes up with something and the board says, are you guys in support of it? Yes, okay, next item. And it's really as simple as that. Audit committees in turn rely on the CFO's office, especially for the listed entities, to obtain the right skills, to make sure that they are on the right side of the law and they are not breaking any rules. And they're supported in part, not always, by their external auditors. So that's how the governance operates in practice. If you ask me, I would argue that perhaps over 80% of the non-executive directors on the boards of these companies are completely clueless about these issues. Because it's been delegated to the subcommittee of the board. They worry about it, but there's nothing they can do about it. So there's an issue here. There's an issue of compliance, and there's an issue of corporate governance. In so far as companies are expected to comply, to report in line with JSE on the one hand, good governance, King 4 or King 5 or whatever they comply with. But when it comes to the nitty-gritty, the non-execs are able to exercise for a variety of reasons. So it's left to the executives. And therefore, there is every reason that if the executives are not let's call ethical, if they've got a conflict of interest, things can go off the rail badly, and there isn't much the board and non-executives can do. I mean, my own learning over the past 25 years is that if I don't trust the executives, I don't sit on the board no matter what. Because at the end of the day, that's what I've learned matters. If your executives want to fudge it, they will cover up, and even external auditors won't catch them.
Thank you, Raz. I mean, I think we've seen a lot of that over the last little while. So the integrity of is absolutely critical. Jenny, I wanted to move to foreign exchange. You know, often the minister in his speech makes a reference to foreign exchange announcements that will be made sort of on the day of the budget. I think this year we've seen some announcements maybe made in advance of the budgets. Has there any more color been added today? Have you seen anything that affects that space at all?
I haven't, Charles. I think my understanding from discussions with authorized dealers is that the Reserve Bank is issuing, or has issued, or will be issuing possibly with effect from the 1st of March. There's some quite significant changes to the exchange control regime, particularly as it applies to individuals. But I haven't seen the content of that manual, the updated manual. So when I last had the discussion, the authorized dealers were providing input into that. So I think we can definitely expect something in the very near future, which will give us some more clarity. Bear in mind that last year's budget, it was announced that the formal immigration process for exchange control purposes is to be phased out, and but what it is to be replaced by, we are still waiting the details. There have been some indications of what might replace it, or what the sort of structure will look like going forward, but I think we're still waiting for confirmation of exactly how it's going to work.
Thanks very much, Jenny. I mean, we've got about 8 minutes left, and we haven't had a significant number of questions that have been asked. So I wonder if we could ask for final comments from the panelists. Kazi, any final comments? A day to remember, or will this just disappear into the background in your tax head?
Of course, the decrease to 27%, a very interesting change. I think for me, I mentioned on the financial services side that collateral change is something that we definitely need to look out for. And the one thing I was actually thinking about, at some point, Treasury mentioned a change that was going to impact the unit trust space, where because CIS's unit trust, they're not subject to CGT in South Africa, but the unit holder is actually subject to CGT when they sell the units. So at some point they were thinking of actually bringing, some kind of taxation in relation to assets within the unit trust that are acquired and disposed of within a short period of time. And then, the industry lobbied because that would have impacted unit trust, the savings space, and would have actually been a nightmare from an implementation point of view in relation to some of the asset managers, etc. So I didn't see anything in the budget. They seem to be quiet about it. So hopefully not to see anything, because we're not looking at any changes that are going to start impacting, savings now. So that was actually quite interesting, because at some point they were pushing for it, but now there was just silence over it. So yeah.
So this novel is still being written. Mike, any final comments from your perspective? Tax is going to stay busy for the next 12 months. The challenges they haven't got easier because of the budget today.
No, I don't think it's got easier, Charles. I think it's obviously there's a lot of work that still needs to be done, and I think what's quite important is maybe to make the appeal to taxpayers at large is that we've got the opportunity to interact with Treasury on these proposed amendments. So one should make use of that opportunity, and I guess that's the next part of this discussion, and the work that lies ahead is to work together with Treasury to formulate taxation legislation that actually works for both parties. It's not just a one-sided affair. So they are open to those discussions and submissions. And we've been quite successful in that. So it's just an appeal to the broader tax community to make use of that opportunity. It is available to every South African taxpayer in any event. Thanks, Charles.
That's a very important process, and one that one should stay close to and influence as much as possible. Jenny, from your perspective, I mean, any final words of wisdom?
Charles, I think the main amendments and future developments in the budget for me are the ones that relate to the retirement fund, to retirement fund benefits. And I think given the significant change with effect from the 1st of March 2021, whereby Provident Fund benefits will have to be annuitized as opposed to being able to be paid entirely in a lump sum benefit, I think we're going to have to look at these future developments in the light of those significant changes. And although vested rights of members in Provident funds, the intention is to protect them, going forward, I think that the interaction between the proposals in the budget and the new regime that applies to provident funds in particular and provident preservation funds is something that interaction is something that we need to watch out for and we need to consider carefully.
Thanks, Jenny. And Iraj, I would love to have explored SOEs with you and the money that is there or isn't there or should be going there. But do you have any words of wisdom after what you've seen today?
I think I'm a bit more optimistic that the minister is not going round about the issues. It's talking straight and has already sent a signal that it's not going to raise taxes and balance the books. It's got to be managing expenditure. That's the general message that came out of this budget speech, which is very market friendly, but also for underpinning growth. That's the right necessary condition. It's not sufficient, but it's a necessary condition, and that's as much as a Minister of Finance and National Treasury can do. Let's hope that they'll stick to that path and over the next 2-3 years get the expenditure under control and the SOEs under competent management, and therefore the economy will regain its growth path. And unless that happens, nothing else really will deal with the problems that we have.
Maybe one question that I wanted to pick up on in the minute or so that we've got left. You know, there's always a concern that the budget is very influenced by politics, and you know the National Treasury, who we have acknowledged and have, you know, is acknowledged and have acknowledged for a long time to be a very good department. But it seems almost as, you know, the message, as you say, was quite straight talking, and you know the politics has been avoided to a pretty large extent. Would you agree with that?
I think from a fiscal literature point of view, a good National Treasury is the one that doesn't get influenced by politicians, but takes full account of politics. The fact is that our society is full of unemployed, is full of maldistribution of income, is full of transfer pricing, etc., etc. And therefore, a National Treasury without being influenced by party politics needs to take care of balancing the fiscal principles with good socio-political principles, and that's the challenge of where the fiscal policy is. The fiscal policy is the crossroad of politics and finance, and you cannot take politics out of it. If you do, you do it at your own peril, and then it will delegitimize the budgetary process. We don't want that either.
Thank you very much, Iraj. Thank you very much to the panel. Happy that you could share your insights with us so shortly after the budget this afternoon, and to all the participants who joined us for this discussion. We hope that we've given you a very brief synopsis of the budget and what we think was important in the process and things that you need to focus on going forward. You know, there will be lots of reaction on TV tonight and in the papers tomorrow, and a number of these aspects will be unpacked in a more in more detail. But thank you very much for joining us this afternoon, and we look forward to having a tax discussion with you shortly. Enjoy your evening.